this lesson, we're going to take a closer look at return on assets and return on equity. So I know you've probably been losing sleep over this one, but do you want to know how well a firm uses its asset base to generate profits? If you do, you're going to use the ROA calculation or the return on investment, which is ROI. Now, you may not be losing as much sleep over this one, but you could be. Do you want to know what the firm's profit is in relation to common shareholder equity? The answer is yes. You want to look at return on equity. So let's start with our basic ROA formula. Here we have net income divided by average total assets. Now, what you might want to do is get out a pencil and paper because you're going to want to write this down. We expand this formula using the DuPont model for ROA. What it is a breakdown by taking net profit margin multiplied by the total asset turnover. Now, if you remember, net profit margin is net income divided by sales, and our total asset turnover is sales divided by our average total assets. So now let's take a look at these formulas using Chicago Serial's Year 2 information. So we'll start with the basic formula to calculate ROA. Here we're taking net income and we're dividing it by our average total assets. These numbers for Chicago Serial are 1,103,000 divided by 11,056. This gives us a return on assets of 10%. Now, let's take a look at the DuPont model and break that down into two pieces. So the first thing we're going to do is look at our net profit margin. So we're going to take our net income of 1,103 and we're going to divide it by sales of 11,776. This gives us 9.4%. Now the second part is to come up with our average total assets or our asset turnover ratio. So here what we're going to do is take our sales, that 11,776, and we're going to divide it by our average total assets of 11,056. Once we do that, we end up with 9.4. No, I take that back. We end up with 1.1. Now, let's see how this works, because what we've done is basically use the same numbers in our basic calculation as we've been using in our DuPont model. So now what we do is we take the 9.4, multiply it by the 1.1, and look what happens. We end up with the exact same ROI of 10%. But now it gives us the ability to focus on two components of the equation, that net profit margin and our asset turnover. So we can look at this and interpret it the way management would as how do we improve our return on assets? Now we can say, I need to improve either my net profit margin or my total asset turnover. This helps management figure out how they can better manage operations to improve return on assets. Now let's review ROE formula the same way that we reviewed our return on assets. So the basic ROE is net income divided by our average common shareholder equity. The DuPont model expands this again into two separate calculations. One we just looked at, return on assets, and we're going to multiply that by our financial leverage. So return on assets is net income divided by our average total assets. And financial leverage, we're looking at taking assets divided by equity. So the basic formula we have is our net income, and we're going to divide it by the average, I'm going to abbreviate here, common stockholder equity. So we have 1,103,000 divided by our average common shareholder equity of 2,298,000, and that gives us a return on equity of 48%. Now, let's take a look at how DuPont breaks this down. So, we'll calculate our ROA again. We're going to take, in this case, the net income, 1,103,000, and we're going to divide it by the average total assets of $11,056,000. This gives us 10%. Now, the second part of the calculation is we're going to now take our total assets, 11,056, and we're going to divide it by the average common shareholder equity, 2,298,000. This gives us 4.8. Now, to calculate the total return on equity, we're going to take the 10%, multiply it by the 4.8, and that gives us 48%, the exact same number that we had come up with using the basic formula. But now, we have the ability to focus on two separate components. So ROA, which is an okay percentage, and financial leverage, which is good, will work well for the company, and that's why we have such a high return on our equity. But we can also interpret this as we can improve our return on equity by improving our return on assets. So let's see how to do this, and we're going to do it in the next few slides. We need to take another pause to erase the board. So the question is, what's in your ROA and ROE? Now comes the warning. How are the following terms defined? So if we look at assets, it can really have three different definitions. Average total assets, just using total assets, or focusing on our operating assets, which really means that we're going to look at our property, plant, and equipment and use that as the asset base to determine what our return on assets is. Next up, we have equity. Again, we can use an average common stockholder equity, we can use total common stockholder equity, or we can simply use total stockholder equity. Next, we have the return. So that's also called our income. Now, we can use net income. We can adjust net income to take out the impact of any preferred cash dividends that we might be paying, or we can use operating income. So it's important to understand what the definition is. Now, another thing that's important for you to understand is how a change in the dollar amount of one line item on the financial statements will impact the resulting ROA and ROE. Now, this information can be used by management to focus on how to improve the DuPont formula components for both equations. So let's take a look at this chart, but I'll start by explaining the headings. So in the first column, we have the components. We start with components of our income statement, going from sales, cost of sales, down to our interest expense. From there, we move to the balance sheet and look at our total assets. We look at total liabilities, and then we actually break down our preferred stock, common stock, and retained earnings, ending up with treasury stock. Now, in the second and third column, we're going to see how a change in each of those components will increase either ROA or increase our return on equity. So let's start with sales. We have sales, if they increase, then both your ROA and your ROE will increase as well. Now, cost of sales has an opposite effect. So if we have a decrease in our cost of sales, that will in turn increase the ROA and the ROE. Selling, general, and administrative works the same way as our cost of sales. Interest expense works the same way, income taxes the same way. Any decrease that we have will serve to increase ROA and ROE. Now, when we move to assets, what we want to look at is we would have to have a decrease in assets in order for our ROA to go up. But a change in assets has absolutely no impact on the ROE calculation. We also see that there's no impact from liabilities and no impact from our preferred stock. But when we move down to the common stock, there is no impact due to a change in the common stock on our ROA, but we do have a decrease in common stock that will serve to increase the return on equity. Retained earnings has no impact on ROA, but a decrease in retained earnings will actually increase ROE. We have treasury stock that has no impact on the ROA calculation, but an increase in the treasury stock will increase the return on equity. Now, the sustainable growth rate formula is this. It's our return on equity multiplied by 1 minus the dividend payout ratio. There's 3 assumptions, though, that go along with this. The first is that the firm will maintain its capital structure of debt to equity. The second is the dividend payout ratio will be constant. The third is that the firm will maintain or increase its sales. So let's see what this means to Chicago Cereal. We already know that their return on equity equals 48%. And we know that the dividend payout ratio is 43.1%. So, plugging this into our formula, we have 0.48 times 1 minus 0.431, which gives us 0.48 times 0.569, resulting in a sustainable growth rate of 0.273 or 27.3%. Now, what this means is that Chicago Cereal Company can increase and grow its business by 27.3% from where it is now without having to take on additional financing in the form of either debt or equity. Now, in conclusion, what we've seen is that we have a lot of return ratios and they're a valuable tool, but we need to make sure that we understand if someone else has done this calculation for us, what the individual components were that were used to get the resulting return on assets and return on equity. This will give us a more valid analysis. And then using that ROE, we're able then to determine the sustainable growth rate, which is an important number to know because that's the point where anything above it, they're going to have to incur additional financing. This will serve to increase the risk.